Hey guys, welcome back to Be Rich. Today we're going to be talking about Howard Marks's book, The Most Important Thing Illuminated. And this is a seminal piece by Howard Marks, and it's one of the first investing books my uncle had made me read to get a grasp on what investing even is. And this is a book I read even before I read Intelligent Investor. This and Peter Lynch's other books, and The Making of an American Capitalist by Warren Buffett, along with The Education of a Value Investor. These are the few books I've read before I read The Intelligent Investor, before I tackled that whale. So today I wanted to bring the topic to you guys so that my uncle and I can go over some of the really important points written by Howard Marks, the activist investor. So I'll start off with a few points and then we can examine each point and then move on to the next. How does that sound?
It looks great, and I want to make two things. Howard Marks runs Oak Tree Capital with Bruce Karish, and they are the lenders of the last resort. If somebody takes money from Oak Tree Capital, I will not buy his equity. If somebody is talking to Oak Tree Capital for money, that means he is in serious trouble, and the money is going to come with serious conditions. And since it's a debt instrument, Howard Marks is going to take it all. And since we are equity investors, when we see Howard Marks in a deal, it's time to pack up and leave the place. So, one of the recent companies in which he has lent money is Vedanta. We knew that Vedanta was in serious trouble. And because we have discussed this several times in the past, that Vedanta's assets are in India level, earning in rupee primarily, whereas his debt is in dollars to be paid out of England. And recently I read a report in which he has borrowed money by pledging all his stake to two people, and both are money lenders of the highest class. One is, of course, Oaktree and Howard Marks, and the other is, of course, Glencore. Glencore, for a long time, was a private company, and where the Rothschilds have an indirect investment. So, this is enough to strike fear in the hearts of many people. And he has survived this year. Next year, he has to make $4.1 billion payment. And the fact that he has touched these two guys, alarms are ringing in my ear for Agarwal. And he's been stopped from having his semiconductor ambitions. So that's been thwarted. The other thing is that the Chinese company which went down and which created all these problems, even that company had a loan from Howard Marks, who had secured a property against his loan, and he took that property. So, as an equity investor, when you see Howard Marks, it's time to pack up and leave the place. I think I also pointed out India Bulls to you, and that
Yes.
group sold out and left. Both India Bulls Real Estate and India Bulls Housing Finance were in serious trouble. And the moment Oak Tree came there, I told you it's time to pack up, if you remember.
Yeah.
So he's an extremely sharp investor. He primarily deals in debt. And if he's giving you money, it's time that you pack up and leave. I have so much respect for him. And the most important thing remains one of the most important books I've read in my life. Takeaway number one.
Yeah. So the most important thing covers a few points, but the first point he makes about is the art of investing. He says that successful investing requires attention to many separate aspects and all of
Mm.
them at the same time. So you have to be good at multitasking. And if you omit any one of them, the result is likely to be less than satisfactory.
I completely agree. We need a checklist.
Yes.
Uh,
And he gives a checklist in the book as well.
yeah, one of the cases where I made a mistake, the case of Syntex Plastics, and I bought it cheap. When they got out of trouble first time, I sold some of the stock for five, six times the money I invested in. And then what happened is when it dropped again, I bought it again. When they decided to split it into two companies, I thought one company will take off. And finally, the loan, especially the foreign loan, sunk it. And the company was taken over by Reliance. And I got out before the actual fake massacre happened. But it was a
Yeah.
hit, and I'm going to remember all my life because I violated my own principle of not touching a company with debt. and that company had humongous debt and bought, of course, it bought foreign subsidiaries, and the subsidiaries did not generate enough cash flow to pay for the loan, and
Yeah.
finally the main company sank. So if you don't look at all the principles which you know are good, you will hurt badly. And luckily for me, I didn't hurt badly because I have this principle of putting only small amounts of money in
Yeah.
all these stocks. It's a loss I could take. It was a minor loss, but it's like Daniel Kahneman and Amos Tversky say, you never forget a loss. So it's going to
Yeah.
stay with me for life. And this is because I violated a principle which I know I should not violate. I believed the brand and I thought the brand will overtake the loans. It will come out of trouble. The guy, after getting into all that mess, went and invested in a new textile plant. The entire company because of that new textile plant. The owner's interest was not aligned with that shareholder's interest. That was the learning in that company. He thought he could get away with a humongous debt. Anyway, let us look at his checklist.
Yes. So the next point he talks about is that this is something which you've been echoing in the past and you continue to echo, which is that good times only teach bad lessons. That good times teaches you that investing is easy, that you know its secrets, and it makes you complacent. But only when interest rates rise, that is very recently, do you realize that maybe you weren't all that you thought you were cut out to be. So, what do you think about this lesson?
I think Silicon Valley Bank learned this lesson the hard way, and they bought 30-year bonds, which lost in value overnight
Yeah,
because we made the basic assumption that money will last forever and it will be cheap and inflation will never come. Now, by all the Indian startups, from Baiju to Ola to
Zomato to
Swiggy
Swiggy,
to are learning this lesson.
Nika. Yeah,
Everybody is learning this lesson. So
yeah,
that the interest rate is a cycle. It will turn. It sometimes it may turn late, but it will
yes,
turn. And so the weak hands will get pulled out. The
yeah,
weak hands are not only companies like Vedanta, but that are also companies which burn cash in huge numbers. This is one lesson. Second,
yeah,
another lesson which Indian investors are learning the hard way by lack of returns is companies like Asian Paints and Relaxo, two
yeah,
different companies. You think that Relaxo is going to grow forever, and you gave it about 80, 90 times PE, and today it is down 30%. The fund manager who evangelized Relaxo has sold out. And the other thing is morning context. Every time there was a reason for why Asian Paints was not doing well. First, it was crude price, and said that there is a crude price problem. The input cost is very high, and that's why Asian Paints is not doing well. The second reason they gave was that they are not able to protect their margins. Asian Paints demonstrated they are still making 37 to 39% margin, albeit slightly lower than their 40% margin. But that reason also fell flat. Now the narrative is there is too much competition, and the competition is beginning to hurt Asian Paints. Of course, Asian Paints has regained some lost ground and value of shares, but has not given any significant return over the last 3 years. The plain reason being it's a business to consumer product, which is depend on how the real estate market does. The real estate market is in a terrible shape in India. How many times will you paint your house? How much paint will you buy? So the growth rate of that company is the problem. When you
yeah,
have an PE multiple of 70 or 80, you expect that the growth has to be 30%, 40% every year. So that if
yeah,
I buy it at 70 times PE, if it grows 100% in 3 years, it will come to 35 times PE because
yes,
the profits would have gone up so much. But
yeah,
Asian Paints is in no position to grow so fast. The amount they are paying 1%, 2% for earnings, when FD is
yes,
giving me 7.5%, which is a
yeah.
violation of a fundamental principle.
Which is that you park your asset wherever you yield the best returns.
Yes, no, but you have to benchmark it against government yield.
Yeah,
If you read Buffett, the company's earnings yield should be higher than at least what you get in a government
treasury
bond.
yield. Yeah,
Yeah, the government bond is 7.5% today. and here you are getting 1%,
Yeah.
and the growth is not there.
So
The
you're not
growth in
getting
the
a return
business,
anywhere.
so and the growth is not compensating. If the growth happens, the profits will go up, and
Yeah.
therefore to retain the same multiple, prices will go up. But there is no
Yes.
growth. So there are three companies in this flock which I want to invest, but I have never invested. One is Asian Paints, the other is Pidilite, and the third is Bata and Relaxo.
Yeah.
So basically, what it is if you have high PEs and you don't have high growth rates, the company is not going to deliver great returns to the investor. Maybe the company's stock price will remain same. But if the stock price has remained same for 3 years, but in 3 years my inflation has eaten away 20% of my
Negative real
value of
returns.
negative real returns, then the stock is also giving me negative real returns. So when if
Yeah.
the fundamental rule is if I'm buying high PE stocks, I should also get high growth. So you cannot have high PE without high growth. It does not sustain. That is
Yes.
something that is what he says. Thank you for supporting Birich. Kindly like this video because the algorithm pushes this only if you go and like the video. Please like the video, subscribe to our channel, and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time me and Shashwath have a chat. Once again, thank you for your support for Birich. I will be in Kuala Lumpur, Malaysia on the 11th of June this year. That is a Sunday. I want to meet you guys at Sheraton Imperial Hotel between 4 p.m. and 7 p.m. on that day. The Sheraton Imperial Hotel is in Jalan Sultan Ismail area near Quill City Mall. The Kuala Lumpur monorail railway station is available nearby. You can meet me there. For further details, you can contact us on the WhatsApp number below or send us an email at the email given below. My team will contact you at the earliest. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written two books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.